Chapter 4: The Valuation of Long-Term Securities. Bond valuation. A bond is a security that pays a stated amount of interest to the investor period after period until it is finally retired by issuing company. In China, bond interest may not be paid annually but until the retirement of the bond. Face value is the stated value of an asset. In the case of bond, the face value is usually $1,000. The face value is supposed to be the back to the bondholders at the principal, no matter what purchasing price of the bond. The model of bond valuation VB is equals to MV over 1 plus RN plus summation N T is equals to 1 IT divided by 1 plus RT. Zero coupon bond. A zero coupon bond is a bond that pays no interest but sells at a deep discount from its face value. It provides compensation to investors in the form of price appreciation. The interest of a zero coupon bond is the remainder of the face value is less issuing price. Preferred stock valuation. Preferred stock is the type of stock that promises a usually fixed dividend, but at the discretion of the directors, it has preference over common stock in the payment of dividends and claims on assets. Cumulative and non-cumulative preferred stock. A cumulative preferred stock is a stock whose dividend is not paid out, is deferred to later years. Common stock valuation. Common stock is the security that represents the ultimate ownership and risk position in a corporation. The difficult issue of valuation, uncertainty, and payment of stock dividend, different risk levels, etc. Dividend discount models. Constant growth. Assume that dividends grow at a constant rate, but in real life, few companies do this. We shall run this in corporate finance. Dividend policy. Assume that D naught is the present dividend per share and G is the growth rate of dividend. According to the valuation model, constant growth stock is valued as constant growth V is equal to D1 over R minus G. Constant growth. Tip. A common mistake made in using the above equation is to use incorrectly the most recent annual dividend for the variable D1 instead of the annual dividend expected by the end of the coming year. No growth. Assume that dividends will be maintained at their current level forever, a kind of dividend policy. V is equal to D1 over R, D naught over R. Rates of return. If we replace intrinsic value of our valuation equation with the market price of the security, we can solve for the market required rate of return. This rate, which sets the discount value of the expected cash flows equal to the security's current market price, is also referred as securities market yield. Yield to maturity on bonds. Yield to maturity is the expected rate of return on a bond if bought at its current market price and held maturity. It is known as the bond's internal rate of return. Yield to maturity P naught is equal to summation 1 over 1 plus ytm की power t plus mv over 1 y plus ymt power n. The difficult issue is it is not a linear function, more complex. Yield on preferred stock and common stock. P naught is equal to dp over r. P naught is equal to d1 over r minus g.